If you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to Morningstar. I'm Emma Wall, and here with me today is Helene Williamson, manager of the First Date Emerging Market Debt Fund, to give me her 3 bond tips. Hello, Helene.
Hello, Emma.
So what's the first tip in emerging market debt?
Well, I think we look at it from a top down and kind of look at countries which are well positioned in the current macroeconomic environment. And we like countries which are exporters into Western Europe, which are tied into the supply chain of Western Europe. So one of the countries we like, for example, is Romania. Romania also has an IMF program, which is at the moment, I think, about to be signed. They have done a fair amount of structural reform with an IMF program recently. And there are elections later in the year, which I think is one of the themes for emerging markets. And I think the elections give you opportunities and have risks. But that's one country where we think is well positioned in the current environment. So we like Romanian bonds, and we're overweight there.
And what's your second tip?
Mm-hmm. We also like the Middle East. We think the Middle East, I think the Middle East doesn't have currency volatility because they're basically pegged to the dollar. Also, the oil price has clearly been very high, and countries like Abu Dhabi have benefited very substantially from the high oil price. There's also there's no currency risk, so there's no currency-induced volatility. And for example, in an Abu Dhabi quasi-sovereign bond trades at the same spread as Mexico, but probably has better local support. So the technical position is very good there. So it's an area where we're also overweight.
Are there other risks, though? You mentioned there's not currency risks in that region, but are there not geopolitical risks in that region?
Yes, clearly. Actually, we think probably they're positive ones, though, because we think that it's likely that the U.S. seems quite advanced in negotiations with Iran, and we think that that may lower the geopolitical risk perception in the region there if a deal is struck.
And what about your third tip then?
I think generically we like quasi-sovereign bonds, which are bonds which are 100% owned by a sovereign, but you get a pickup over the sovereign. So in areas where we like the sovereign, for example, Mexico, we think that getting paid another 60 basis points is for essentially the same risk is very attractive. So that's another area where we'd be overweight.
And what are the risks there? Is there a risk because it is state-owned? Or state-run?
Yes, I think, you could argue, on a standalone basis, maybe their credit risk is not that good. But if you're 100% sovereign-owned, I think that you get paid well for that risk. I think the risk at the difference between a Mexico or a Pemex is that Pemex may issue more debt, so you may have a technical situation which is weaker than that of Mexico. Mexico has already said that they're unlikely to come to market, at least with a long-dated bond, while Pemex has indicated that there's a lot more to come from them.
But you do get paid for that?
Yes.
Helene, thank you very much.
Thank you, Emma.
This is Emma Wall from Morningstar. Thank you for watching.